Most people lose money before they ever buy a bad stock. The real mistake happens much earlier, when they start thinking like gamblers instead of owners. Every day, millions of investors chase hot tips, breaking news, and fast-moving prices, believing the next winning stock will change their future. Warren Buffett built one of the greatest investing records in history by doing the exact opposite. Before he invested a single dollar, he followed one simple rule that eliminated countless bad decisions before they could happen. That rule wasn't about predicting the market or finding secret information. It was about learning how to think. And surprisingly, it's a rule that almost anyone can apply. Stay with me, because later you'll discover why Buffett willingly ignored thousands of companies that everyone else was excited about, and why that decision made him richer, not poorer. You'll also learn a simple mental test near the end of this video that can instantly help you avoid investments you don't truly understand. By the time we're finished, you may never look at a stock ticker the same way again. Instead, you'll begin seeing what Buffett sees: real businesses, real value, and real ownership. The difference between Warren Buffett and the average investor isn't a higher IQ or access to secret information. It's the lens through which he views every investment. While most people see a stock symbol flashing across a screen, Buffett sees a real business with employees, customers, products, and profits. He isn't asking, will this stock go up next week? He's asking, would I be happy owning this business for the next 10 years? That single shift changes everything. Too many investors spend their time watching charts, headlines, and market predictions. Buffett spends his time understanding how a company makes money, whether it has a lasting competitive advantage, and whether its managers allocate capital wisely. In his mind, investing is like owning a farm. A farmer doesn't panic because someone offers a lower price for the land one afternoon. He focuses on whether the farm continues producing healthy crops year after year. Great businesses work the same way. This video is for educational purposes and should not be considered financial advice. Because once you begin thinking like an owner instead of a trader, Buffett's most important investing rule starts to feel not only logical, but obvious. Warren Buffett has often said that the size of your circle of competence isn't what matters. What matters is knowing exactly where its boundaries are. In a world that celebrates knowing a little about everything, Buffett built his fortune by deeply understanding a few things exceptionally well. He never felt pressured to invest in every exciting company or every new trend. If he couldn't clearly explain how a business made money and why customers would continue choosing it years from now, he simply walked away. Think of your circle of competence as playing on your home field. On your own field, you know every corner, every advantage, and every challenge. Step onto unfamiliar ground, and even simple decisions become risky. Investing works the same way. Confidence should come from understanding, not excitement. For years, Buffett avoided many technology companies because he believed they were outside his expertise. While investors rushed into businesses they barely understood, he patiently waited. Only after studying Apple and recognizing the strength of its brand, loyal customers, and powerful ecosystem did he decide it belonged inside his circle of competence. It wasn't the technology itself that convinced him, it was the quality and predictability of the business. The psychology behind this rule is surprisingly simple. People naturally fear missing out. When everyone seems to be making money from the latest trend, it feels uncomfortable to do nothing. But Buffett understands that saying no is often more valuable than saying yes. Every investment you avoid because you don't understand it protects your capital for opportunities you truly recognize. Before you ever think about buying a stock, ask yourself one question: could I explain this company's business model to a friend in just a few minutes? If the answer is no, you probably don't understand it well enough to invest. Knowledge isn't about sounding smart. It's about reducing unnecessary risk. But even understanding a great business isn't enough. Because the next rule protects you from something every investor experiences sooner or later: the possibility of being wrong. Understanding a great business is only half the equation. The other half is making sure you don't pay too much for it. This is where one of Warren Buffett's most important investing principles comes into play: the margin of safety. Borrowed from his mentor Benjamin Graham, this idea is simple but powerful. No matter how confident you feel, leave room for mistakes. In investing, certainty is an illusion, and humility is an advantage. Think of a margin of safety as a seatbelt in a car. You never put it on because you expect an accident. You wear it because unexpected things happen. The same is true when buying a business. Even outstanding companies can face economic downturns, unexpected competition, or management mistakes. Paying a reasonable price gives you a cushion when reality doesn't unfold exactly as planned. Buffett has often reminded investors that a wonderful company is not automatically a wonderful investment if the price is too high. Price is what you pay. Value is what you get. That's why he would rather wait patiently than chase a stock simply because everyone else is buying it. A great example is American Express. During periods when fear dominated the market and many investors rushed to sell, Buffett focused on the long-term strength of the business rather than the temporary panic surrounding it. Because he understood the company's durable brand and customer loyalty, he saw opportunity where others saw danger. He wasn't buying headlines, he was buying value. The psychology behind this rule is one of the biggest reasons investors struggle. Fear of missing out pushes people to pay almost any price when excitement is high. Buffett does the opposite. He knows that discipline is often rewarded more than speed. Waiting may feel unproductive, but patience protects both your money and your future decisions. Here's a practical habit you can start today. Before investing in any company, don't just ask, "Is this a great business?" Ask, "Am I paying a sensible price for this business?" That single question can prevent many expensive mistakes. Still, buying wisely is only part of building wealth. The next principle reveals the invisible force that transformed Buffett's fortune over decades, and it has far more to do with time than with talent. If there is one force Warren Buffett respects more than almost anything else in investing, it is time. People often assume his extraordinary wealth came from finding spectacular investments. In reality, much of it came from allowing great investments to grow for decades without constantly interrupting the process. Buffett once described compound interest as one of the most powerful forces in finance, and his life is proof of what patience can achieve. Imagine a snowball rolling down a long, snowy hill. At first, it looks small and unimpressive. But with every turn, it gathers more snow, becomes heavier, and grows faster. Wealth works the same way. In the beginning, progress feels slow. Many investors become discouraged because they expect dramatic results within months. Buffett understands that the biggest rewards often arrive after years of consistent discipline. Consider a simple story about two friends, Adam and Ben. Both begin investing the same amount of money at the same age. Adam checks the market every day, jumps between trending stocks, and buys or sells whenever headlines create excitement or fear. Ben takes a different approach. He carefully chooses strong businesses, ignores daily market noise, and allows his investments to compound year after year. 20 years later, Ben hasn't succeeded because he predicted the market better. He succeeded because he gave compounding enough time to work without constantly getting in its way. A real-world example is Coca-Cola, one of Buffett's most famous long-term investments. Instead of treating it like a short-term trade, he viewed it as ownership in a business with a globally recognized brand, loyal customers, and consistent earnings. By holding the investment for decades, Berkshire Hathaway benefited not only from the company's growth but also from the increasing value created over time. Buffett didn't become wealthy by constantly searching for the next opportunity. He became wealthy by staying committed to exceptional businesses. The psychology behind this rule is challenging because our brains crave immediate rewards. We celebrate quick wins and underestimate small, consistent progress. But investing isn't a race to see who gets rich first. It's a marathon where patience quietly outperforms excitement. Every unnecessary trade has the potential to interrupt the compounding process you've worked so hard to build. Here's a practical takeaway. Stop measuring your investments by what they did this week or even this month. Instead, ask yourself whether the business is likely to be stronger 5 or 10 years from now. If the answer is yes, short-term price movements become far less important. Time can turn a good investment into an extraordinary one, but only if your emotions don't force you to abandon it too soon. And that leads to Buffett's final lesson, the principle that allowed him to stay calm while others panicked and seize opportunities when the rest of the market was running away. Most investors see a falling market as a warning sign. Warren Buffett sees it as a shopping season. That doesn't mean every market decline is a buying opportunity. It means lower prices alone don't make a great business worse. Buffett has always separated the value of a business from the emotions of the market. That's why one of his most famous ideas is so powerful: volatility is not risk. Real risk comes from not understanding what you own or paying far more than it's worth. Think of a great business as a money machine. Every day, it continues serving customers, selling products, and generating profits whether the stock market is excited or terrified. The market may change its opinion from one week to the next, but the business itself doesn't suddenly stop creating value because its share price falls. Buffett focuses on the machine, not the noise surrounding it. This mindset became especially clear during periods of market panic. While many investors rushed to sell quality businesses simply because prices were falling, Berkshire Hathaway remained patient. Buffett understood that fear often creates opportunities for disciplined investors. He didn't feel pressured to act every day. Instead, he waited until exceptional businesses became available at attractive prices. His patience wasn't passive, it was strategic. That brings us to another important reframe: cash isn't lazy. Cash creates opportunity. Many people believe money sitting on the sidelines is wasted. Buffett sees it differently. Holding cash gives you flexibility. It allows you to move confidently when great businesses become temporarily undervalued instead of scrambling to find money after opportunities appear. Now the two questions we opened at the beginning have their answers. Why did Buffett ignore thousands of companies? Because he refused to invest outside his circle of competence or chase businesses that didn't meet his standards. And what is the simple mental test that eliminates many bad investments? Before buying any stock, ask yourself, would I be comfortable owning this entire business if the stock market closed for the next 10 years? If that question makes you hesitate, Buffett would likely tell you to keep looking. This single rule transforms investing from speculation into ownership. It replaces excitement with patience, fear with discipline, and short-term predictions with long-term thinking. The market will always swing between optimism and panic. Your job isn't to swing with it. Your job is to remain rational while everyone else is reacting emotionally. And that's the lesson that ties everything together. Buffett's greatest investment wasn't just in outstanding businesses, it was in a way of thinking that stayed steady when the rest of the world lost its balance. The greatest lesson Warren Buffett teaches isn't how to pick the next winning stock. It's how to think before you invest. Everything we've covered points back to one timeless rule: never invest in something you don't truly understand. Stay inside your circle of competence. Demand a margin of safety. Give compounding the time it deserves. And welcome market volatility instead of fearing it. These aren't shortcuts to getting rich, they're principles for making better decisions over a lifetime. Remember the metaphors we've used throughout this video. Treat investing like owning a farm, not trading lottery tickets. Wear a margin of safety like a seatbelt. Let your wealth grow like a snowball rolling downhill. And always focus on the money machine, the business itself, not the daily movements of its stock price. If you adopt this mindset, something powerful begins to change. You stop asking, "What's the hottest stock today?" and start asking, "Is this a business I'd be proud to own for years?" That's the moment you stop thinking like a speculator and begin thinking like Warren Buffett. So before you make your next investment, pause and ask yourself one simple question: am I buying a stock, or am I buying a business? That single question can save you from countless costly mistakes and keep you focused on what truly matters. If you found this lesson valuable, let me know in the comments which Buffett principle changed your perspective the most. Subscribe for weekly Buffett lessons designed to help you become a calmer, wiser, and more disciplined investor. And if you're ready to keep learning, watch the next video, where we'll explore another timeless investing lesson from Warren Buffett that could completely change the way you see money. Because in the end, the goal isn't to gamble anymore. It's to think like an owner.